Welcome to the Explainer. Today we're diving into something that is absolutely critical for any trader, the entry point. We're going to break down exactly how you can perfect your timing by looking at three totally different but really powerful models that are all based on pure price action. All right, let's start with a feeling I'm sure we've all had. You know the one, you see what looks like the perfect setup, you get all excited, you jump in, and almost immediately the market just turns on a dime and stops you out. Sound familiar? Look, if it does, it's probably not just bad luck. It's more likely a misunderstanding of how, and even more importantly, when you should be getting into the market. So here's the game plan for today. First, we'll tackle the entry dilemma itself. Then we'll break down our three models: the aggressive entry, the balanced entry, and the confirmation entry. After that, we'll get into the strategist's view, when to use which one. And finally, we'll wrap it up by talking about how to build your own toolkit. All right, sounds good? Let's get into it. All right, section 1, the entry dilemma. And really, it's all about why timing is everything. To really drive this home, we're going to look at two chart setups that look, for all intents and purposes, identical right at that key decision-making moment. This is where trades are won and lost. Okay, take a look at this. On the left, you've got the winning trade. It's a textbook break and retest, right? Price breaks a key level, pulls back, finds support, and then just takes off. Beautiful. But then on the right, you have the losing trade. It looks like the exact same setup is unfolding, but this time that retest completely fails. Price just slices right back through and boom, you're stopped out. So our job, the real challenge, is figuring out which one of these is more likely to happen before we put our money on the line. All right, on to our first model, the aggressive entry. In Vietnamese, this is often called Lang Che. This is really the most aggressive way you can get into a trade. Think of it like you're setting a trap and just waiting for the price to walk right into it. So here's how it works. You find a key level, say a resistance that price just broke through. You're expecting it to come back and retest that level. So what do? You place your buy limit order right on that line, and then you can literally walk away. If and when the price comes back and touches your level, you're in the trade. It's automatic. There's absolutely zero further confirmation needed. Now this is where it gets really interesting, because you've got this huge trade-off. On the plus side, you get the absolute best possible entry price, and that means you have the potential for the highest risk-to-reward ratio. You're also guaranteed to get in, so you'll never miss the move if it works. But, and this is a big but, the downside is you're looking at the lowest win rate, somewhere around 30 to 40%. Why? Because you're totally exposed to fake outs, and that can lead to a lot of unnecessary losses. Okay, so let's move on to model number 2, the balanced entry, or xauusd. This one is, a much more balanced approach. Instead of just jumping in blindly with a limit order, this is all about waiting for the market to give you a little clue, a little signal that things might be going your way. Okay, so picture this. Price is coming back to that key level, but this time you don't have an order waiting. Instead, you're watching the candles form in real time. You're looking for some kind of sign, right? Maybe you see a hammer candle with a big long wick on the bottom. What's that telling you? It's telling you that buyers are stepping in and fighting back. As soon as you see that clear sign of strength, that's when you hit the button and enter the trade. And this really is the perfect middle ground. You're getting some confirmation that, buyers are actually here. This bumps your win rate up to around 50%, which is a nice improvement. It also often lets you use a tighter stop loss, which helps keep your risk to reward looking pretty good. Now what's the catch? The main downside is that it's more subjective, right? It's discretionary. What one trader sees as a strong signal, another might not. And that can be a real challenge, especially when you're starting out. All right, that brings us to our third and final model, the confirmation entry, or Che Sac Nien. This is by far the most conservative approach. We're not looking for little clues or signals anymore. No, this method is all about waiting for cold, hard, undeniable proof that the momentum is truly in your favor before you put any money on the line. So the rule here is super simple and 100% mechanical. Price comes back, it retests the level, and you see that first sign of strength, that candle with the long wick. But you don't enter, not yet. You wait for the next candle to completely form, and this is the key, to close above the high of that first signal candle. That close is your definitive confirmation. That's the market screaming at you that the momentum has shifted. So, what's the payoff for all that patience? Well, it's a huge one. You get the highest win rate of all, often somewhere between 60 and 70%. You'll get caught in very, very few fake outs. But All that safety comes at a price. Literally, you're getting in much later, which means you're getting a worse entry price. This really shrinks your potential risk to reward. You're basically trading potential profit for a higher probability of being right. And this chart just puts it all together visually. It perfectly sums up that core trade-off we've been talking about. As you move from left to right, from the aggressive set it and forget it entry, to the balanced approach, and all the way over to the super safe confirmation entry, your rules get stricter. And as your rules get stricter, your win rate, it just climbs and climbs. Okay, so now you know the three models. Great. But just knowing them isn't the whole story, right? The real skill of a trader is knowing which tool to pull out of the toolbox for the right job. So how in the world do you decide? When should you be aggressive, and when should you sit on your hands and be patient? So when is it okay to be aggressive and use that limit order? Honestly, not very often. You should really only even think about it when everything is lining up perfectly. We're talking a crystal clear setup on a higher time frame. You have what traders call A+ market conditions, strong momentum, clear direction. Another good time is when you're trading to the downside. Moves down are often like an elevator dropping. They're fast and they don't give you a second chance to get on. A limit order might be your only ticket. Okay, so then when should you be patient and wait for confirmation? The simple answer is probably most of the time. If there's no clear direction on the higher time frames, if price is just bouncing around inside a choppy range, if the market just feels sluggish and lacks that strong push, patience is your absolute best friend. Waiting for that extra confirmation is what's going to stop you from getting chopped to pieces, and it'll save your money for the really good A+ setups. Okay, let's start wrapping this up and build your entry toolkit. The most important thing I want you to take away is this. You have to stop thinking of these three models as being in competition with each other. They're not. They're just three different tools in your toolkit, and each one is perfect for a very specific job. I want you to think about this like a ladder of confirmation. Right at the bottom rung, you've got the limit order. That's for those rare, super high conviction trades in fast markets. Step up a rung, and you've got the price action signal, a fantastic balance of risk and confirmation. And then at the very top of the ladder, you have the confirmation candle. That's your go-to for maximum safety, especially when the market feels uncertain. So what's the big takeaway here? It's that the best entry isn't just about what the chart looks like. It's about the market, and it's about you. So before you even think about placing a trade, you have to ask yourself two questions. First, what are the current market conditions telling me? And second, what is my personal risk tolerance okay with? You have to decide, are you a gunslinger ready to take the quick shot, or are you a sniper willing to wait patiently for the perfect moment? That choice, right there, is what will ultimately define your results.